It's impressive. Now, all right, we're going to look at another. This is another situation where you have somebody stepping down, longtime founder of a company, Canadian, a legendary investor, really in the Canadian markets that stepped down. But Constellation Software is the company he run, and CSU and the TSX. We've got a number of questions on this with the company coming down in share price after really, no stock does this over time, but it's done this. And then you saw a drop in the share price, and Brett's going to let you know why.
Yeah, so we got a submission from James, but we've got, I don't know how many questions on Constellation, especially recently with the share price decline. It's just been tons and tons of them, but I will say James did submit one. And yeah, like Ryan was saying, Mark Leonard, some people actually compare him to Buffett, ironically, the Canadian Buffett for tech. So this is the Buffett show today. But yeah, no, it's really been a big change over the past few months. The stock's declined quite a bit, so we'll get into why it's declined and go from there. So Constellation Software is a Canadian acquirer, manager of vertical market software businesses. The company acquires cash flowing companies and then subsequently uses that cash flow to acquire more businesses. The company has more than 125 different verticals and over 100 companies. The company has 6 operating groups: Valeris, Harris, Jonas, Vela, Perseus, and Topicus. But it should also be noted that Topicus and Lumine, which they operate under Valeris, also have publicly traded shares under TOI and LMNN as they were spun out in the past 5 years, both of them. But Constellation remains a holder of the shares. So the stock has really had just a phenomenal performance, to say the least, since its IPO in 2006, with over an 18,000%, and that's not including the dividend reinvestments or anything like that, just purely share price returns. So it's no surprise that many people are holders of the company, as it's massive in size for the Canadian market. As you can see there at the end of the chart, it came down over the past 6 months, declining over 30% in the past 6 months. From the peak, it's about 35%. So why has this happened? As you can see here, just really since August, that you can see that first dip, real big dip there, being that their Q2 earnings. But there was a couple reasons for the pullback. First, the one which I want to go into was the stepping down of president and founder Mark Leonard due to health reasons. So unexpected. He will remain as a director on the board. Mark Miller, different Mark Miller, the current CEO, will succeed Leonard. I would not be overly concerned in this development like I have been some people, as Mark Leonard, legendary investor figure, and I think that's where some of the concerns, same sort of thing in the Buffett, where you have that pinnacle name stepping down. But given the the company is autonomous within its business groups, and it's not a top down, it's quite spread out, quite autonomous is the word which I will keep repeating here probably. So there's strength behind the company, really just in the structure it is, not to need reliance on a single person. The real strength, I would say, is the company's long-term capital deployment strength, meeting their criteria, which I have up there. If you go to their website, looks like it's early 2000s, but they have their clear acquisition lined out right on their website. So while the stock did fall 6% after the announcement, following the announcement, I would say that business's day-to-day just isn't going to really change. The company did have a conference following the leadership change with the new president, Mark Miller, stating, "I really think it's business as usual. I just continue to push ahead with our existing strategy." And just for context, Miller has been with Constellation for over 30 years, so it's not exactly a new face. You don't have an outside entity coming in and you're expecting some massive shakeup. So I'd expect ultimately a very similar overall philosophy and not a dramatic change. So even though it is a short-term negative, but I don't think it's going to be a really business disruptor. It's not really inherent to a 30% drop. But what's been being picked up more and more, because that was only, of course, 6% of the 30-some-odd percent, wherever you want to measure it from, is the AI fear in the market. The fear of AI-based solutions just eating away at the underlying software's market share, regardless of what vertical it is really what is driving, I would say, the larger concern. However, on the other hand, the company can actually integrate AI into its own solutions as it sees fit. So you have these two sides to the AI introduction to the business. whether it's the negative being disruptive or a positive when them integrating themselves. Management is very conscious of this potential risk. They actually held a conference call, which almost never did. They didn't do quarterly conference calls, an outlier in the space, but they held one for AI. So they are very conscious of it. And the real question which they're pondering at this time is, and I think much of the market is, whether the AI is a 10x productivity improvement or is it a 10%, because you have very two different outcomes. Is if it's a 10%, you'll have some shifts, minor shifts here, but if a 10x change in productivity, you can actually have significant disruption. And that's what the share price is saying, is they're expecting a bit of a disruption. Whether that's 30%, that's the question for speculation. The company's MD&A has also just added a new risk factor saying many of our businesses use or plan to use artificial intelligence in their operations. Challenges with incorporating and managing its use may result in competitive harm or adversely affect the results of our businesses. So risk very apparent. The management, this isn't a surprise, but given the market's really unease around AI, it is a risk. Will it lower the barriers to entries for new competitors? Likely, but to what degree? But at the same time, the company can actually benefit from its own use of AI. So I'd really say this is not a clear win or loss. It's just a change. And it's something which over time we're going to need to see how the company adapts. Does it adapt well? Is it going to adapt quick enough? Are customers going to still want to purchase their verticals for whatever the software in whatever the respective vertical is? Further, the company has not seen any shifts in acquisition valuation, which this is, I think, is a key piece of information, because if AI really starts to bite, that would likely appear. You would see a shift where the AI companies, they start to see or AI software starts to really see these inflated valuations across the board, and the ones which are getting pushed out, you see valuations decline. So that will be something to watch. Any commentary around that. And we can see a quick look into the financials. This is in US dollars. Revenue growth of 16% to 2.9 billion, of which 5% was organic, or 3% after foreign exchange impact. You can see the bottom table, which I have up on the screen, does not have significant organic growth. It is a growth by acquisition story. That's nothing new. That is the business. But it does show just how much of their growth is powered by acquisitions. You are not looking for that organic growth story. The company still has great free cash flow per share growth over time, and that's free cash flow available to shareholders because they do account for the non-controlling interest. While the quarterly figures are lumpy with seasonality, the company is still seeing good growth. Quarterly FCF grew by 46% to $24.96 a share. But if you look at the trailing 12 months, clear out some of that noise, it was only an increase of 32.2%. Still great, just not as great. Not going to downplay that. It's still great growth. So despite the fears in the market contraction, the fundamental growth of the company on a trailing basis has still been strong. Now, I will note here, GAAP EPS is just really, in my opinion, not a great judge of the company's operating performance because of amortization, which is one of the few times which I will really say GAAP isn't great, because it's not really representing the economic reality of the company, as amortization of the intangible assets which they are acquiring has a degree of subjectivity for the life of the asset. So while you do want to watch GAAP, it's not as there are some subjectivity in it, where most of the time there is less than the adjusted or alternative figures. Cash flow is a great figure for Constellation. One of the big factors for Constellation is actually the share count has effectively stayed the same since the IPO. They have not been issuing shares ever. They've only taken mild amounts of debt. You can see net debt and lease of 2.37 billion. That's relatively small compared to the market cap. But the shares have just stayed the same at 21.2 million for 18 years. That is just very strange to see. And it is actually quite great to see, especially for a company this size. You aren't seeing that dilution like you do in many other places. But shifting to valuations, we can see the premium valuation has declined. Currently, the shares are around 29.2 times free cash flow. Compared to the post Q2 drop, it was still at 40.7. And then just halfway through the year, relatively arbitrary date, June 30th, it was at 48.8 times. This is a clear re-rating in the company, if you want to consider it that way, or it's, if you're looking at it as like a DCF or something, it's a higher discount rate. The market is pricing in higher risk within the company, or lower growth, or a combination. So that really we'll wrap this up. The stock is really, in my opinion, more interesting than what it has previously been, as it's always had a high valuation for many, many years, and now it's come down quite a bit. Despite the really dampening view, the financials so far continue to be strong. The sudden stepping down of Mark Leonard would be more concerning if the company really didn't have a strict return on investment guidelines and relatively autonomous nature of its groups. The threat and or opportunity of AI is really yet to be seen. We are not seeing that appear in the financials yet. That is something which you will want to watch if you are considering or are invested in this company, is how do they adapt to AI? How does AI progress? Is it actually disruptive, or is it an opportunity? Because that's really the billion-dollar question at this time. But the stock price itself will likely swing quite a bit, just depending on AI sentiment over short periods of time. And I think that's what we're seeing here is AI sentiment is seen as a threat right now. We saw that with Google. Is it going to be a threat 6 months from now? Or is it going to be an opportunity? So for now, we'll continue to monitor the stock. But if someone is willing to take a long-term view, this could be an opportunity. Just keep an eye on how AI develops as a threat or opportunity. But it's not by no means some absurd valuation like it has been previously. I would say it's a better opportunity than what there has been in recent years. And for disclosure, we do not have any investment or relationship to the company.
Yeah. Awesome. Like, and that's the thing. Even in one of our chats, like this was a couple weeks ago, we had one of our clients comment, will SaaS businesses be negatively impacted by AI? And he referenced, Larry Berman was on BNN, just commenting that the downturn of Constellation Software is, related to, that paradigm. And like, it's just such a broad statement. Again, like some SaaS businesses will be able to benefit from AI. And of course, AI is going to, affect or impact plenty of businesses, including SaaS businesses as well. So like they're not exempt from, not being negatively affected by AI. But, I just think that the broad blanket across everything that, AI is going to disrupt all SaaS businesses is maybe a little out there.
Yeah, and I think the volatility, the market trying to price in some risk or benefit, and really just not knowing. I mean, we went over at the start of this podcast with Alphabet. The market tried to price in risk at the start of the year. Now it's literally flipped from you could have bought it at 140, and now it's going to close at $318 today. Like that was 6 months ago. So I don't think the market has fully digested, and players have fully digested the future on what AI's impact will have on many of these companies. If it is, well, it's never business as usual. There's going to be changes. They're going to have to adapt if they can. They're trading at the low end of their 10-year. Constellation is their low end of their 10-year price to cash flow multiple. So that's usually a good time to buy a high quality business. Now, the organic growth rate is always, when I've looked at it, said, they've capital compounded tremendously well. They have increased debt to do it, but it's manageable. But, you're talking maybe 2 to 3, 4%, and if that were to slip to negative, then it's an issue. I mean, if they can still just do that minimum level, it probably makes sense, but the way they've been able to strategically acquire so successfully and compound capital. But, it'd be nice if they had 10% growth rate organically. It's never going to be there, but at least keep it positive. Keep it positive, and then I think you probably look back as a significant entry point. If that turns negative and somehow AI affects them in a negative way, then that's why you've seen the share price come off. There is risk where it was just an execution story, and there wasn't this nebulous risk sitting out there for years, and now it's there, and the market's trying to deal with that, price that in. Steady hand, it may actually be a good long term, buying point right now.